Have you ever wondered how those massive real estate projects get funded? You know, the huge ones, the skyline changers,
Yeah.
beyond just bank loans or like direct ownership.
Yeah, there's this fascinating sort of middle ground that people often overlook, but it's actually becoming, well, pretty critical.
And that middle ground is exactly what we're getting into today, preferred equity in real estate.
Right. It's this financial tool that's really gaining traction, becoming almost indispensable in today's investment world.
So our goal for you in this deep dive is to really unpack it. What is preferred equity? Why is it suddenly so popular? And, how is it actually reshaping real estate investment?
We're pulling insights from sources like Preferred Equity, Real Estate Capital Innovation, the ALAN blog, trying to give you a clear path through it.
Think of it as a shortcut, yeah, to understanding something that sounds complex but is super important.
Exactly. It sits in this unique spot,
Right.
right between traditional debt and common equity, kind of a blend of both worlds.
Understanding that position is really key, isn't it, to getting a grip on modern real estate finance.
Absolutely.
Okay, so let's unpack that definition a bit more. Dr. Ghamari calls it a compelling middle ground. What does that actually mean when you're talking about a real estate deal?
Well, the core thing is preferred equity gives investors a return, usually fixed, sometimes negotiated.
A preferred return.
Yes, a preferred return. And the crucial part is it gets paid before any money goes to the common equity holders, the main owners.
Ah, okay, so they're first in line for payouts after the debt is handled, of course.
Precisely. So investors get that priority, that more predictable cash flow. But, and this is important, without all the really strict rules, the covenants that often come with traditional bank loans.
Right, those covenants can really tie a developer's hands. So preferred equity offers that steady payout, but with more operational freedom for the project itself.
Exactly. And that's a big deal for the sponsors, the developers, the fund managers. They keep more operational control.
And they still get to share in the success if the project does well. They get some of the upside.
They do. They still participate. That operational freedom, coupled with upside potential, that's a huge differentiator from just taking on more debt.
It sounds like it. It's not just about the return structure then. It's about flexibility.
It absolutely is. I mean,
Yeah.
you could say the real game changer here is how it acts like a pressure release valve for these big projects.
How so?
Well, think about when credit markets tighten up, or when brewing in too much common equity would dilute the original sponsors too much. Preferred equity steps into that gap.
So it helps projects get off the ground that might otherwise stall out because funding is tricky.
Exactly. It unlocks deals.
That makes a ton of sense, especially now with market conditions being, well, volatile. Our sources talk about this, the economic appeal. How does preferred equity specifically help with today's challenges, where maybe getting a traditional loan is tougher?
Yeah, that's a key question, isn't it? What do you do when debt is scarce, or the interest rates are just too high? Or, on the flip side, you don't want to give away too much of the ownership via common equity.
Right.
Preferred equity is the strategic answer. For investors, you get downside protection because you're higher up in the payment queue.
Okay, so less risky than common equity.
Generally, yes,
Mm-hmm.
but you still have potential for, equity-like returns if the project really takes off. It's not just a flat interest payment like debt.
That mixed downside protection, but still having some upside, that sounds like it would appeal to certain investors, like institutions. What's their risk appetite look like for this?
Spot on. Institutional investors often need stable income, but they also want some growth potential. Preferred equity can deliver that.
And are there specific types of real estate where this is particularly popular right now?
Definitely. The sources point strongly towards multifamily housing apartments, basically. Also logistics facilities like warehouses, distribution centers, and healthcare real estate.
Why those sectors specifically?
Because they tend to show pretty robust demand, even when the economy gets a bit shaky. They generate relatively stable income streams. That makes the preferred equity structure really appealing there. Stable income plus that growth kicker.
Okay, so we've got the basic structure, the economic appeal, but things are evolving, right? How is technology, like digital platforms, changing the game for preferred equity? You mentioned ALAN earlier.
Right. Platforms like AppealIn are really shaking things up. They're making it much easier to do these deals across borders, international transactions.
How do they manage that? Compliance must be complex.
They streamline it, they handle the compliance, the capital flow,
Yeah.
makes it much smoother. So for investors, it means easier access to global opportunities, diversification.
And for the sponsors, the
Yeah.
developers.
They get access to a much wider pool of capital. They can find the right investors from potentially anywhere using these digital tools. It optimizes their capital stack.
And it's not just about making international deals easier, is it? I read about even more cutting-edge stuff, like blockchain, Gold, something called preferred equity tokenization.
Yes, that's where things get really innovative. Tokenization, often using blockchain technology, sometimes through partnerships like the one mentioned with Gold, it allows for fractional ownership.
For fractional ownership. So you could buy just a small piece of a preferred equity stake in a large project.
Exactly. Think about it, that dramatically increases liquidity. Real estate is famously illiquid, right? Hard to sell quickly.
Yeah, definitely. Long lockup periods usually.
Tokenization can change that. It potentially allows investors to trade these fractional states more easily. Plus, it can enhance transparency and governance. For investors wary of those long lockups, this is a huge shift. Liquid access to real estate.
Wow. Fractional ownership, more liquidity through blockchain, that really could open things up. Now, shifting gears slightly, but still related to innovation, Dr. Ghamari also talks about integrating cause-related marketing, ESG, into these preferred equity deals. Why bring that in?
It's a really interesting point. It's not just about the financial return anymore. The idea is that integrating ESG, environmental, social, governance factors strengthens trust, builds investor loyalty.
How so? Is it just good PR?
It's more than that. It helps funds differentiate themselves. There's a lot of competition for capital out there. And crucially, investors themselves are increasingly demanding responsible investment options. They want their money to do good as well as generate returns.
So it meets a growing market demand. Are there actual, measurable benefits, though, beyond just feeling good?
Yes, definitely. The research, like stuff from the AppealIn blog, shows real results. Funds that genuinely embrace ESG and social responsibility, they've seen faster fundraising, better investor retention rates.
Faster fundraising and keeping investors longer, that's tangible.
Absolutely. And platforms like AppealIn also offer digital marketing tools to help sponsors communicate these ESG initiatives effectively. That builds confidence, transparency, and potentially even boosts the value people place on the fund or the assets.
So it's good for branding, good for attracting capital, and potentially good for valuations. Okay, that makes a strong business case. So bringing this all together, if someone's actually looking to structure one of these preferred equity deals, what are the key practical things they need to nail?
Good question. Structure is everything. First, you absolutely have to clearly define that preferred return rate and the payment frequency. Make sure it aligns perfectly with how the project is expected to generate cash. No surprises.
Manage expectations up front. Got it. What else?
Flexibility is key too, as we touched on. You need to think carefully about redemption rights, when and how investors can get their capital back. And conversion rights, can they convert their preferred equity into common equity later?
Ah, balancing security for the investor with incentives for the sponsor.
Exactly. It's a balancing act. Another big practical point, leverage those digital platforms. Use things like AppealIn to automate reporting, compliance checks, investor updates. It saves time, reduces errors, boosts transparency.
Makes sense. Use the tech. And connecting back to ESG.
Right. If you're incorporating cause-related marketing or ESG, make sure those messages truly align with the fund's actual objectives and activities. Don't just slap a label on it. Use measurable ESG metrics. Show. Don't just tell.
Measurable metrics for transparency. Crucial.
And finally, don't be afraid to actively explore tokenization. Look into options, maybe via platforms like Gold, to broaden your investor base and offer that enhanced liquidity we talked about. It's the future for many asset classes.
What a fascinating area. So to sort of wrap up, preferred equity really does seem to uniquely bridge these gaps in real estate finance.
It does. It offers that compelling blend, a different risk-return profile that works for both investors looking for prioritized returns and developers needing flexible capital.
Its adaptability seems key. It's not just one size fits all.
No, definitely not.
Nice.
It's a testament to financial innovation, really, offering stability, but also that potential for growth in a market that's always changing.
Okay, so here's a final thought to leave you with. Given all this flexibility we've discussed, and especially the potential of digital innovation like tokenization, how might preferred equity fundamentally reshape access to real estate investment? not just for institutions, but maybe even for the average person in the years to come.
That is the big question, isn't it? Could this be a key to democratizing access to sophisticated real estate deals?
Feels like we might be on the verge of something really transformative there. Lots to think about.